Episode 14.
Rocking and rolling. Let's do this. I wonder if people know it's not supposed to be yellow. Like it does change.
It does change from yellow, yeah. It's just our cool
Intro.
motif of the intro.
Here we go. Well, hello, everyone, and welcome to another episode of the Lending Podcast. We are your hosts. That's Jeff Jones.
Hey.
And I'm John Burnham. Thanks for being with us today. We are going to bring you a topic on debt to income ratios. We're going to demystify what debt to income ratios mean, why it's important, and it's kind of one of those topics that it can go in a lot of different directions here.
Yeah. So we always look at overcoming challenges for people. And one of the things that people really worry about is like, what can they afford? And that's kind of what a debt to income ratio is looking at. So it's basically your buying power,
That's right.
So we want to kind of talk through what that equations look like and what goes into it so people know up front what we're looking at.
Well, it's true. And the equation itself is debt to income, which is total debt divided by your income. Here's the key. How is your income calculated?
Yes.
That's probably the biggest piece of the puzzle. And what our clients are making right now may not necessarily be what we can use for qualifying. So if it's a fairly new job or you have variable income and all these different types of sources of income that may come in, side hustles, things like that, what you're making right now may not be what we can use to qualify you. And so your qualifying income is really the first piece, making sure that we have that number exact. Once we know the qualifying income, then we can calculate the debt to income ratio, which determines how much you can buy depending on the loan program. And guess what? All loan programs have different guidelines for debt to income ratio.
So it's not as simple as what do I qualify for?
Not at all.
Not at all. So this is the one thing that a lot of people that are getting into the lending industry, it's probably one of the biggest learning curves, I think, in our industry is figuring out the right way to figure out income calculations based on every single program option.
That's right.
And because there are so many, I mean, we have about 250 programs just here at Benchmark that we have offered. And so if you're looking at examples of like a VA loan, well, it's a residual income calculation. It's actually not a debt to income calculation. If you're looking at, your basic conventional or even an FHA, it is a pretty typical calculation. If you're self-employed, it's a whole nother ball of wax. If you go jumbo, there's other things we can count that you can't count in conventional, like, stock units and things like that.
Right.
And those self-employed calculations are very complicated at times. Depends on how complicated people's tax returns are.
True.
So, and then you have a whole nother category of non-qualified mortgage. So you can do bank statement loans. You can do
Calculates the income
DSCR
in a
loans,
totally different way.
which is going to look at the property's income instead of your income. So there is a lot to consider. And sometimes it all for me starts with the consultation with the client, right?
True.
So when we get an application in, hopefully there's a story already had with that client that we know what kind of property they're looking at. We generally know, what their income source is. Are they self-employed or they're not? And then we also hopefully know if they're a VA or not. So that helps guide the initial calculation. But then when it comes to a follow-up, I feel like that second phone call after an application review really tightens up, the income, because that helps us figure out what program to put them in. And then based on the program, we can do the right calculation.
For sure. And the other piece of that is how much home are you looking to buy? What is your monthly budget? So we're unpacking that. And I'll give you an example from literally from yesterday. Have a client who is salaried, has a very nice base salary. On the side, he has a consulting business that brings in maybe 10% of what he makes in his salary, right? Like a small number. It's really nice extra income, but he doesn't need that to qualify. So there's also the element of, do we need all the income that you're bringing in? Do we need to squeeze every dollar out of your qualifying income to help you buy the home that you want to buy? Or is your base income good? You have some auxiliary income. It's nice. We can show that you have other sources of income, but we may not need to take a deep dive on verifying all that and coming up with an income calculation for this extra income to add to your base salary to give you this bigger number to qualify for more house, only to find out that you don't really want to buy more house. You want to keep your payment lower.
Oh,
So
that's good. I
that
like that.
conversation is super important. So do we need to use
Yeah.
all of the income that you're making? Let's just say we do. Okay, we have a client, and for whatever reason, we're really trying to max out their pre-approval. Here's the question we get all the time: how much house can I buy? And the answer is it's about your payment, what payment you can afford, not necessarily what the price of the home is, right?
Yes.
Because again, the debt to income ratio, that matrix that we're putting you in, depending on the loan program, we're gonna unpack those loan programs in a minute. But depending on the loan program that you're going through, we have a maximum, right, debt to income ratio that we can put you in.
Mm-hmm.
And so based on your debt and based on that income calculation, we're doing that formula and we're saying you best fit into one of these couple of programs because of a specific ratio, because of the specific calculation. And it could be different. Disclaimer, various mortgage companies can calculate income differently.
Yes, if it's their own agency loan. Yeah. So that is, again, it's almost like thinking each company is almost its own program,
Right.
right? And when we're talking programs, we're talking like what bank is underwriting that loan.
Mm-hmm.
And so they all have guidelines, and those guidelines will have a debt to income ratio or some kind of income requirement. And the biggest thing of the reason why is you and I are in the business of making sure people get their homes and specializing really the right scenario for that person.
Mm-hmm.
So as the architect of the program, we're putting together this idea of, hey, you fit best into this program. Here's other options. This is one we recommend most because it makes the most sense for your scenario. But the reality is, that scenario might be different if you talk to a different lender because they might have different products and programs. um,
Yeah, we get that a lot where
mhm.
we may have a client call us for a second opinion. They've worked with a bank, and let's just say the bank approved them for 300,000, and
Right.
they're really hoping to get in this neighborhood where the prices are more maybe 350. Well, how can we qualify for more house? Well, there are legitimate calculations to
Yeah.
use to get there, and so there's two ways to do it. We either have to use more income, or we have to reduce debt.
Right.
And the debt to income ratio is just that. It's your total debt divided by your total income. Now, when we talk about debt, I will say real quick,
Yeah.
that is the debt that's showing up on your credit report. And also, there's a few debts that may not show up on your credit report, like maybe a payment plan to the IRS, or maybe child support sometimes isn't on there, but it's coming out of your paycheck stubs. So we're going to uncover exactly what are those forced debts on a monthly basis. We're not talking about cell phone bills. We're not talking about car insurance, health insurance, food, gas, things like that. We're talking about credit monthly debts
Right.
and your proposed payment on your mortgage.
Yeah.
Yeah.
And that's good. So, I mean, so you have two sides of that, right? You have the debt side, you have the income side. I like how you're talking about auxiliary income. That's a good way to describe, say you get your run of the mill W-2 that you get, but you drive an Uber, or like you said, you have a side hustle you've been doing for a
Mhm.
while that shows up on your tax return that you can count, or there might be other kind of sources of income, child support, social security, whatever it might be. Um, each of those are counted in different ways. So that it's two different calculations that we have to add together. That gives you your total income, and this is before taxes. That's
Right.
the other
This
nice
is
thing.
gross monthly
This is
income.
gross. It's not just what's showing up in your bank account.
And there's certain incomes that we can use a calculation to gross up. We can add 25% onto that number. So let's take non-taxable
Right.
Social Security income or VA disability benefits because they're not taxed by the federal government. So if they're not taxed, then the only way to really standardize that calculation is to increase that number. We add 25%
Yeah.
to that number, which kind of presumes you're in a 25% tax bracket. But if you gross up that number, if it's a $4,000 income and we're grossing it up 25%, that now makes it $5,000. So you're qualifying at $5,000 a month, but you're really making $4,000. But the $4,000 is non-taxable. so we can use those calculations. Those are all the chess pieces that we're moving
Yeah.
on a files. Now, I did want to circle back to each specific program having a debt to income ratio maximum
Yes.
and why you might go this program versus that program.
Good.
We're not take a super deep dive here, but I just want to touch on there's USDA, conventional, FHA, VA, and then we have jumbo and non-qualifying. Okay, let's take USDA. So USDA's maximum debt to income ratio is about 43%. Okay, 41 to 43%. Total debt divided by total income. Conventional usually can go up to 49.9, roughly 50%. We'd like to see you under 45, but the maximum is about 49.9. FHA goes to 54 to 56% on occasion. It may not be for everybody across the board. You need to have a stronger credit profile, maybe a stronger asset base, some other reserves, but the automated system will allow us to go higher on FHA. Right. You touched on VA being more of a residual calculation. There really isn't a posted maximum debt to income ratio on VA because of that. So when you look at that across the board, how much home can I buy? Technically, it could be different on 4 different loan programs.
That's right.
And then jumbo's a whole different animal. It will be different.
Yeah.
You know, because it's not really how much home can you afford sales price wise. It's how much debt, how much loan amount can you take out? What is the subsequent payment because of that mortgage payment, that mortgage amount that you're borrowing? That payment then is divided into your income with your other debts, and we come up with your debt to income calculation.
Yes, and the debt does include the new mortgage you're going to be getting. So it's it's principal, interest, taxes, insurance are included on top of your liability debts on your credit report. And like you said, some other things that might not show up on your credit report, we have to include. So that's debts.
Yeah, that's debts. And so let's talk about some creative ways to eliminate debt. Okay, so let's say that perhaps we're talking to a client and they have 5% to put down, and their debt to income ratio may be a little on the high side because they've got this car payment over here, and the car still has about a year and a half to be before it's paid off. We may suggest something like, let's take some of that down payment money, look at paying off the car or refinancing the car into a lower payment. Maybe take the payment from $500 a month to $200 a month because you only have a little bit left on it, or pay it off completely. And if we do that, when we do that, a $300 a month car payment reduction, that's going to help you buy another $35 to $40, maybe $50,000 in house.
Right.
So how do you go from a $300,000 pre-approval to a $350,000 pre-approval if your income is the number? It's not going to change. We've maxed that out. We look at those debts. Can we pay off a revolving debt, maybe a credit card? Can we pay off an installment debt, maybe a car?
And sometimes you don't need to pay 100% of it off if there's less than, say, 10 months left on it.
That's right.
So you can actually pay down your payments all the way to, a handful of payments left. So you don't have to go 100% payoff.
Yeah, we'll exclude, in many cases, there are some exceptions. We will exclude installment debts if they are less than 10 months from being paid off. So you have 6 months left on your car payment. In many cases, we're not going to actually count that car payment against you on paper. There are some exceptions. That's why you have to talk to someone.
That can save a couple $1,000s.
It can, yeah. And that's a way to stretch that approval. So you talk to one lender and they say, hey, you're approved for X amount, and you're talking with them about some creative strategies, like how can we get this approval amount up, and they're not really giving you the guidance on that. That is to me, it's a red flag. You need to get a second opinion,
right? Because
there are multiple ways, especially on the conventional loans. You can buy out the monthly mortgage insurance. If you don't have monthly mortgage insurance,
I love that option.
That reduces your payment. That increases how much home you can buy, and it may only be $10,000 or $15,000, but that's perhaps what puts you over the edge to get that home that you really want, or negotiate better with the seller because you're at a gap between what the seller wants and what you want to pay, or what you're able to pay for what you thought you were qualified for. So this debt to income ratio, kind of the myths around it is that the number's the number. Oh, we're capped. We can't do anything about it. That's not true. Like, there are some chess pieces we can move. Of course, you can shop your home insurance and maybe get that a little less expensive.
Right.
Newer homes may have cheaper home insurance, probably will have cheaper home insurance. We just got some property tax deductions
Yeah.
increased in the last year, so our property taxes have come down in many cases. And so all of those pieces together will help you maximize that pre-approval amount if that's your goal, or, and this is the other piece, or it can reduce your debt to income ratio calculation based on how we structure the loan, which on a conventional loan reduce the risk, it reduces the cost of your loan and can reduce your mortgage insurance and therefore reduce your payment.
So you're saying the lower your debt to income ratio, that actually affects the rate.
It can,
A lot of
absolutely.
people don't know that.
That's right. It can affect your APR, which is your annualized percentage rate. It might not affect your note rate. The mortgage note rate for 30 years might be set, but the lower debt to income ratio, we're seeing this especially across the board
Right.
with our PMI companies, and these are specifically on conventional loans. We're seeing the lower debt to income ratios, so lower risk, right? Lending is all about risk. The lower the debt to income ratio, the lower the monthly cost
Right.
for the PMI, which is also another reason why putting a lower down payment in this market might make more sense. So you can keep more of your cash. Savings accounts out there, brokerage accounts are paying significant amount, 4, 5, 6% just to put money in a savings account.
Yeah.
So why put a ton of money down on the house when you can get that kind of return on your money? So those are all things that we talk about, part of the holistic picture. You bet. It's a lot.
That was a lot.
Now,
That was good though.
the other piece, and we didn't really get into, was the jumbo and the non-qualifying mortgages. You touched on that with the bank statements and the DSCR loans. So some of the programs we have don't even really look at your personal income.
Right.
They're just looking at what is the property going to make in rental income,
Right.
or what kind of money is flowing through your bank statements if you have a self-employed situation. And the other thing too is, how long has your business been in play, right? So a lot of times we'll get a call, hey, I just started a new business. It's making $30,000 a month. How long you've been doing it? 4 months. Okay, well, it's just not established enough in most
Right.
cases, right? But when you get to 6 months, maybe 12 months, even if you don't have 2 years of tax returns, which is typically the number that we hear, clients come to us and they say, well, I heard that you have to have 2 years of self-employment income to qualify. Not necessarily the case, for these reasons that we're talking
Right.
about. Bank statement loans, 1 year of tax returns is possible. So how we calculate debt to income ratio is really important that we have. It's important that we have all the information. Otherwise, we don't have
Yeah, and
what we
it's so
need.
hard to cover it in like a 20, 30 minute time frame because the calculations are pretty in depth. So if you take like a self-employment calculation, there are instances we might only need 1 year calculation based off tax returns. Sometimes we need 2 year, and sometimes if it's a business, we need like 2.5.
Yeah.
So it needs to be more than 24 months. So all that to say is like a self-employment calculation on, say, a conventional loan, we actually have a spreadsheet.
Mm-hmm.
So we're going through your tax return and putting all the right columns into like the inputs on a spreadsheet. It's called the 1084 calculation.
Right.
You can even look it up and find your own spreadsheet. They're public information. So if you want to figure out your own income calculation, it's available there online.
That's right.
And so the hard part is, as your CPA, your tax advisor might be advising to write off as much as you can so you don't owe as much. Our end, we want to make sure those deductions are in the right columns to give you the best income calculation, because some of those deductions come back to you on our income calculation and some don't. They're just written off, and so that doesn't count towards your income. So all that to say is, if you're in a scenario where you're self-employed and you're writing stuff off like a lot of good people do, you want to know what yours is going to be, contact your lender, because that can really help out in your future.
Yeah, and I think we touched on this potentially on a previous episode,
Mm-hmm.
where the bank statement program for a lot of our self-employed clients may be the better route, so that as a self-employed
Right.
individual, you are taking those deductions and writing off those deductions that you're able to write off per the tax code, the IRS tax code, which reduces your qualifying income, which that's kind of a frowny face when it comes to what can you qualify for. But wait, there's more. Then you can actually use the bank statement program and we go
Yeah,
off of your deposits, we're not going off of the net AGI, adjusted gross income, on your tax return. So
that's good.
you're
That's it's almost a difference between, tax return, bottom line 31 of what your net
yeah,
is compared to a cash flow,
that's
right?
right.
A cash flow strength that bank statements will show.
Hmm.
And those are very different animals. Different programs one could look at this, but another one could look at bank
That's
statements.
right. And so those are, guess what? Two completely different debt to income ratio calculations, two totally different sales price
It's wild.
slash loan amount qualifications, right?
It's wild because it could be the same person and you will not qualify for this because of what's on your net on your tax return, but you will qualify under this program.
That's right.
So, if you ever get turned down for a home loan, but you feel like you should be qualifying for one, you do need that second opinion because there are a lot of other programs available
You bet. You
that
bet.
could work.
Yeah, and it's the intake that's important. We're
Yeah.
taking all the information that we can. We're finding out your goals. We're finding out, just unpacking all those financial pieces, and then we really take all that, build a strategy with you. And there's just so many ways to slice it. So yeah, so we're
There's not one product that works for everybody.
true. True.
It's just for every unique scenario out there, we have a unique product.
That's right. And different banks have different specialties.
Right.
I mean, we do have a massively wide array of products here, and those fit 99% probably of the programs that are needed by our clients.
Right.
There may be a small minority that um, just may not fit for whatever reason, and so we then have industry professionals that we know, that we network with, and we say, you know what, you need to talk to this person. They've got a better program for you, and
Yeah.
that honesty and transparency is super important. If we are
It
not the
is.
best fit for you, we'll tell you.
And there's even programs that need no income.
That's
So
true.
we actually do, you're 62 and better.
That's right.
We have a reverse mortgage where you need no income.
That's right.
So there is no income calculation on that one, which is
Yeah,
very
and
different.
you touched on that. So reverse mortgages, also maybe in that same age bracket, you have the retirement income
That's an
piece,
amazing
and
one.
so
Yeah.
using retirement income to generate a monthly income to then help your debt to income ratio to
Hmm.
buy more house.
And like that asset depletion. So if
Yes,
you have like a huge 401k but you don't get enough social security to qualify for your home, that big asset can actually be turned into like a monthly payment scenario that shows that you can get 3 years of monthly payments on that.
that's right.
And so that is a different kind of calculation.
Help you qualify. Yeah, and we've
We're like
had.
sprinkling in all these little nuanced
I
ones at
know
the end of the
that's
video.
that's
It's good
true.
though.
That's true. A lot of information. Well, because we have a lot of clients
Yeah,
that are of retirement age, and they are concerned about, like, can I qualify for a $500,000 mortgage? I don't.
right.
I only have my Social Security income. Well, yes, but you've got this big nest egg, and that's what you're talking about, is using that nest egg and turning it into an income. So
Hmm.
that's that's what's fun, really, about our job. Every single client situation is unique. We love looking at all those, and we've seen thousands of different scenarios, and we can help you as well. So thank you for tuning in today. Anything else you want to add?
Well, I just want to give a shout out that we hit over 100
Oh,
subscribers,
yes, we did.
117 today.
Thank you
So
all.
thank you all for subscribing. Please continue to share it with your friends and family. Anybody you know that is thinking of buying a home or buying their next home, we're here for you.
It's
Thank you so
awesome.
much.
Thanks so much. Take care.
Bye.